So this course is about time series analysis, and which I think is one of the extremely important course for if you want to be a data scientist. And because time series analysis is effectively very popular in pretty much any kind of uh, analysis you want to do, statistical analysis, data analysis. Time series analysis is kind of obvious, and it's out of hundreds of data, at least 40-50% of data you will see are time series data. And there are lots of variety of, even within time series domain, there are lots of variety of time series data. So I'm in this book, I'm going to follow the main textbook will be Shumway and Stouffer. This book I'm going to follow, particularly the first 3 to 4 chapters, really the main course structure of this book. So I'm going to follow if this book to have your own copy. I think the Indian version is available now. Obviously, I will just assume that you guys are absolutely familiar with regression classifications, all the training, testing, machine learning algorithms. I will assume that, I don't have to repeat anything. Okay. So what is time series data? When the data is observed over time, that is typically the time series data by definition. Obviously, which are adjacent, the values which are adjacent over time, they will tend to be correlated. So your independence assumption is out of the window. Any standard statistical analysis that you have done, you have learned in your probability statistics course, and many algorithms of that you have learned in your data mining, machine learning, these are all algorithms assumes that the instances are independent, right? So for example, in your computer vision, if you work with the MNIST data, all the computer vision data, they just assumes that your instances are independent, right? Whether a cat image and a next image is a dog's image, it doesn't matter. If whether they're coming in sequence or not sequence, doesn't matter. These each instances are independent. You assumes that, right? But here, that assumption is not, you are not privy to make that assumption. So this is the first thing. So assumption of independence is out of window. So in the Shumway-Stouffer page 1, it says that the systematic approach by which one goes about answering the mathematical and statistical question posed by the time correlations is commonly referred to as time series analysis. So basically, whenever you have a time series data, and obviously your data points are correlated, there is no way you can have a correlation 0. I'm not saying it cannot be 0. You can have but most likely you cannot make that assumption that your data, you have a time series data and correlation is 0. That will be a really bad assumption to be worked with on when you are handling time series data. Okay, so you simply cannot make that assumption. Under such situation, what are the mathematical questions, what are the statistical questions are being posed, and how can we answer them? That is what we want to answer in this course. That is the objective of this course. This data set you have already seen in your regression and classification data, international airline passenger data, also known as that we work with, and in those are assumption inherent. Okay, so those models work good that basic with the time series model, with the trend, with the sinusoidal Fourier curve engineering, those things worked, and they did almost 90%, predictive accuracy. Fine, perfectly fine. But inherently in those models, we assumed that those data were independent. The model assumes that the data coming from an independent setup, but we now know that it is not necessarily independent. Okay, so can we go beyond a simple regular time regression models and try to build something more than which will naturally handle the correlated assumptions. Okay. So this is, if you take a log transformation, how the Box-Jenkins airline data looks like. Okay. So typically my experience, and I have told you of before also, when you are working with economic data, typically, if you do a log transformation, generally it works well, because as the economy typically grow at certain growth rate. By means it is growing at a certain growth rate, it means it is growing at an exponential rate, right? So naturally, if you do a log transformation on any kind of economic data, and airline passenger is basically a result of a economic activity, because basically in the economy, the activity is going up, overall activity is growing. If the activity is growing, people are traveling a lot more, and that is getting reflected here, right? So that was getting reflected here. It looks like exponential growth. If you take a log, if you see an exponential growth like this, you take a log transformation with certain scale, maybe log base 10, maybe log base yield, or maybe log base 2, 3, 4, you decide. But you decide that, do the transformation, you will see that you are getting some kind of linear effect. The data gets linearized. Here is TCS close prices from 3rd January 2005 to 5th January 2024. Okay, till Friday of this. So this is, again, we see a sort of an exponential kind of growth here. If you take a log transformation, obviously during 2008, Lehman Brothers, huge collapse of the TCS stock price, the whole market collapsed at that time, but TCS stock price bounced back, and we see a sort of a linear growth in TCS, in a log linear growth in the TCS. And again, the overall TCS has become so big now. By the 2005, 2006, it became so big. Overall economy grows, overall global economy grows. Their software exports has grown exponentially. They are the market leader, and that is getting resulted into the TCS stock price. Another old data, quarterly earnings per Johnson and Johnson, and this is share basically. And then again, you see an exponential growth in the economic data. And then what we do, if you take again log-based 10 thing, again it becomes a linear. So whenever you work with economic data or social data, and you just first do a plot and see if there is this sort of exponential growth you see, do a log transformation. And you will see immediately how, the thing is, you have to work out between whether it's a base 10 or base 2 or base E, what base you want to do. But typically, if you do a log transformation, it generally captures the exponential growth very nicely and transform your data into a log linear scale as a function of time. Okay. So when working with economic data such as sales, revenue, profit, share price, unemployment rate, inflation rate, any of these data, if you're working with, and so on, it advisable to manage it using logarithmic scale. Always use logarithmic scale. Okay. Now let us come to our different kind of data. Population record by US Census, right? This is not economic data. Sort of, it is related to economics. Population and economics are very closely, because if the population grows, economic activity grows. Now, 1800, it's a newborn country. Its population is growing. It grow at a very, exponential rate. Now, you can see there is a sudden slowdown that happened during, I think, Second World War. Okay. And then again, it took its own pace. Okay. So now if you take a logarithmic scale, now you see a very different story. Even if it is actually is growing, but now in logarithmic scale, what it is saying that it's gradually the rate by 1960, it started slowing down. Okay. It started slowing down. And now if you take the most recent data, population data, what you will see, most likely, it has kind of plateaued at 2. Okay. So why 2? Because 2 is the sort of a stabilization rate. Economy, if the population is growing at a rate of 2, basically every parents, every mother and father is getting replaced by 2 children, right? So 2 is the called replacement rate. So if you're, if right now India's population is 1.4 billion, right? 140 crore, 140 crore. Right now, I think our birth rate or replacement rate is 2.1, and it is going down to 2.010203, something like that. Eventually, what will happen if we can keep at 2, slightly above 2, but below 2.1, then population experts are saying that our population will stabilize somewhere between 1.5 billion to 1.6 billion and will not grow after that. And it will stabilize at that rate. And what we can learn from China lesson? China went to the one-child policy. As a result, their replacement rate went down below 2. Now they're hitting already the rock bottom, and now they're saying that their population size will start shrinking. If the Chinese population starts sinking, there is a good possibility their economy also will start sinking, because economy is always reflection of the population size. Obviously at a scale of per capita income, right? Whatever be your per capita income, but if the population size shrinks, there is a good chance that same thing happened with the Japanese economy, because Japanese population is an aging population. They didn't shrink, but they have stabilized, and overall population is an aging population. And as a result, what happened in the Japanese economy, the number of working population is smaller than the number of aged population. So pension seeker is more than the people who are actually working. So that's a problem they have. Okay. So anyway, that's a complete different story, but these kind of time series data, you can say a lot more, but at this moment, let us move on to focus back to the time series data. So when we working with the economic data, such as sales, revenue, profit, you should work with the logarithmic scale. The field of social science, research examine population indicators such as birth rate, population size, and others. It is crucial to ask in long-term trends when analyzing these data. So you have to be, obviously, you want to check whether they are happening in a logarithmic scale, exponential growth, what is the birth rate and all, but overall, what is the long-term trend? So modeling the trend for when you are doing a population science, what is modeling the long-term trend is the most important part. Okay, so you will see that it is also time series data. Population data is also time series data, but the perspective is different. In the when we are studying population science, we are interested more in the long-term trend. So that is what we are trying to do here. Here's a very another story. Daily new COVID-19 cases in India between 2020 and 2023 till July or something. So how many bumps we are seeing? First bump, second wave, third wave, fourth wave, and maybe at the beginning of the 23, there was a fifth wave. We never even realized that there was a fifth wave. Okay, when we plot them, then we realized, okay, there was a small fifth wave came and gone, and we were not even aware of. When we plot it in log scale, now fifth wave is absolutely clear. First wave, second wave, third wave, fourth wave, and fifth wave. Clear, it is absolutely dead clear that there was a fifth wave. Okay, but we didn't even realize because sheer scale was so small. Like, maybe we were getting 1,000 cases or, 500 cases per year, per day. So we didn't bother that much. Okay. Because in India, unless it is something, 1,000 cases in UK, they will be like, close down everything, go into the hole. And in India, 1,000 cases, chalo, let's do party. Okay. So finally, the epidemiologists are always intrigued by the temporal trajectory of the COVID cases or any pandemic kind of cases, whether they demonstrate exponential growth. And here, epidemiologist in the population science, your growth is always on a positive horizon, right? It will rarest of the rarest cases, it will go into the negative horizon. But obviously, if you are studying pandemic, kind of a disease modeling, you always want it to be on the negative horizon. So you want a negative, whether it is on an exponential growth, everything will happen in exponential in pandemic kind of a, disease model, so you want it as either, if it is growing, if it will grow at a very fast down, it dies down very fast. So this is what it happens. So there is a basically something called R naught. Basically, each infected person is infected how many people? If one infected person is infecting another one person, then it is a stabilization. It is at a stabilized rate. If the in one infected person is stabilizing on an average little more than one person, then the disease is spreading. Okay. But if one infected person is infecting little less than even 0.99 chalega, but if it is little less than 1, that means the disease is dying down. Obviously, the epidemiologist always, look at the R naught figure, just like a, hawk. Now, here is an interesting data. Annual Canadian lynx trappings. So lynx is a sort of a cat kind of animal, slightly bigger than cat. Okay. but not like as big as cheetah or something. It's a slightly medium-sized cat. It's most definitely smaller than cheetah or leopard, but larger than the typical wild cat or normal cat. Uh, but yeah, it's slightly never heard that it attacks the human, but it is better to be away from these guys. It's a typically wild cat, and trapping so of these animals, you can see there is a clearly going up and down. The number of trappings is have a cycle, and this cycle is happening because the population is growing and dying, growing and dying, growing and dying. When the population grows up, then the menace goes up, and then hunter will go and hunt them. The number of hunting will go up, and their population will go down. Then hunter will not go down, so the number of tapping will go down. So it is something like that. Okay. This is a very different data set, monthly sunspot data from 1749. Every month's data, it's a monthly data. Okay. So number of sunspot in every month. And you can see there is a clear sinusoidal behavior. You can see that, it's going up, going down, going up, going down kind of thing. Okay. And also it has its own. So this is something always, it says that when the number of spots goes up, you can see it say the solar activity increases. As the solar magnetic field, it may have some effect on the magnetic field of the earth that might trigger uh, activity like volcano. That I don't know whether these are the. I'm not an expert on these things, but definitely people who study astronomy, a good number of astronomers do keep eyes on the number of sunspots. Here is another data set, New York air quality measurements. You can see that as if the data set is being erased in the middle, it is not erased, it is missing data. You can often find bunch of time series data with lots of missing data. Okay, how we do with that, how to deal with the missing data is a big problem. I will deal with this issue at the end if time permits. Otherwise, I will just give it a go. This is very popular data set called flow of river Nile at Aswan in Egypt. In Egypt, Aswan, and somewhere in the south of the Egypt, river Nile flow from south to north. Okay, and interestingly, if you see, this is the annual value of river Nile flow, and somewhere around 1900, there is a sudden drop in the flow level. Okay. And any guess why sudden drop in the flow level? A drought will be for 1 year or 2 years. So it will just overall, but overall level has gone down. So basically, British at that time put up a dam there in the Aswan. So because of that, the flow of the river become much more regulated. So these data set often being used by the statistician to estimate the change point. Where exactly can you estimate where the change took place? right? Somewhere here, 1900 and 1920. And if you can estimate the change point, then okay. And then can you go back and check exactly when the regulation of the implementation of the dam happens? Okay. So change point estimation of the time series is a very interesting problem. Lots of applications are there in the change point of the change point estimation. Great invention and scientific discoveries in each year between 1860 and 1959. Now, 1880 and 1900 were between these are the major inventions took place. That is the time the second major industrialization actually happens. Remember that in 1860 to 1865 is the time when the American Civil War took place. After that, from about 1870 to 1914, till that time, US was in a relatively peace moment. There were no war, there were no fightings or anything. That is the time where American economy grew 6, 7, 8% rate. And they made a serious wealth over a period of 50 years. Over a period of 50 years, and that is where they got the largest, they become the largest economy of the world. And then 1914, the war broke out, I mean, First World War broke out. And obviously, since then, the whole thing kind of goes down. This data you have seen already. I want to make it out. This is the global temperature deviations. So these are not the actual temperature. These are the deviation from the temperatures. Okay, and the deviations are constantly increasing. So that shows that if your deviations is increasing, not the actual temperature. So obviously, overall temperature is increasing. Speech data. So one syllable, somebody says ah, and that ah sampled at 10,000 in per second, 10,000 points will be recorded. And here we have just plotted 1020 points. So it is like 1/10 of the 1 second. And this ah sound that we create, that see the complexity of that ah sound in the 1/10 of the 1 second. The speech, the sound. So if you say something, right, I can record that as a MP3 file. Now read that MP3 file in either Python or R. So it will give you a time series, and now they plot the time series. Okay. Frequency in hertz. That's it. Now, return of New York Stock Exchange data, valued weighted market returns from February 84 to December 31. And this is the time when a crash happened, called Black Friday crash, October 19, 1987. It happens in 1938. So these are the log returns of the log return is basically you take the log value of the New York Stock Exchange, like S&P 500, and take the consecutive differences. That is called typically log return. And you can see that when the crash happened, it was like really of the huge outlier. Okay, at a given time point, not study one variables, more than one. Here, we are studying the Southern Oscillation Index, which is the climate index that measures the atmospheric pressure difference between Tahiti, Darwin, and Darwin, Australia over Indian Ocean. Okay. Now, so this will be a time series. Along with that, you study associated recruitment, which is number of new fish you are catching, or the overall, the fishermen are catching in the same area. And now you can see that between 1950 and 1990, Southern Oscillation Index, you can see there is a sort of a pattern is there. Some kind of sinusoidal pattern is there. Since it's an index, typically it should be between a range-bound manner. So that is also happening, -1 to 1, fine. And there is a pattern in the sinusoidal pattern. And the recruitment of the new fish also happening in a sort of a sinusoidal pattern. It is sometimes going down, sometimes going up. This is a separate. So number of new fish, that means goes up, means the diversity in the ocean goes up. When the number of new fish is going down, the diversity goes down. And that is associated with the obviously climatic condition of the domain, of the area. So what nowadays people are saying that obviously if your climatic conditions changes, the diversity will also get affected. Either it become too diverse or it will become like, dominated by one particular species, all other species will die out. So either case can happen. And what is good, what is bad, we don't know. Generally, it tend to be believed that diversity is good. It makes the system much more resilient. The climatic conditions more resilient ecosystem. Here is another fun data set. On the first panel, we present, this is a case time series data of earthquakes. Okay. And the next panel it's a time series data for explosion, nuclear explosion. Right? It was not nuclear explosion. It was, I think, dynamite explosion probably. But anyway, the explosion behavior will be very different than the earthquake. So just looking at, if you just plot the seismic data, looking at the seismic data, you can say whether it is because of the earthquake or because of the seismic activity is happening because of the explosion. Okay. So up to this, that's what I have today. And next day, I will do some hands-on on these data only. So next day, bring your laptop. So we will start with the hands-on. And then again, so I'll keep going back and forth between theory and hands-on.